Hello, I'm Noelle Lim on ASEAN Speaks by Maybank. The Federal Reserve had hiked interest rates by 75 basis points, the largest increase at a meeting since 1994. What are the implications for ASEAN? And as food inflation remains a concern, is the crisis nearing its peak? Meanwhile, a country that is in the headlines is Laos, hit by a currency depreciation, surging inflation, and fuel shortages. Will Laos default on its debts? Head of Fixed Income Research Winson Phoon discusses these issues in this weekly briefing.
Hi, good morning everyone. It's 8 o'clock on Monday. A quick recap for last week. The US Fed Reserve raised interest rate by 75 bps, the biggest increase at a meeting since 1994. Global sell-off in risk assets deepened on fears of high inflation and aggressive central bank tightening. There were signs of flight to cash. The amount of overnight cash at the Fed repo facility reached another all-time high at 2.23 trillion. The S&P 500 index fell 5.8%, Euro Stoxx 50 down 4.5%, Japan's Nikkei down 6.7%, and in ASEAN, stock indices were down by between 2 and 5%. The only bright spot was China, where the Shanghai Composite Index increased 1% last week. Bitcoin plunged below 20,000 before recovering. The Bloomberg Galaxy Index, which measures the broad performance of crypto assets, has fallen by more than 30% in June alone. On fixed income, there was some divergence. G4 sovereigns outperformed credits. Credit spreads widened, especially in the high yield sector. The US corporate high yield spreads widened by a substantial 64 bp to more than 500. The US Treasury yield curve 210 inverted again last week, following the first inversion in March. The Fed Fund futures currently are pricing in US interest rate to go up to 3.8% at the peak over the next 12 months. That means almost an additional 200 bp of increase before expecting a cut from second half of 2023. Central bank meetings last week, in addition to the Fed, we also had the Bank of England, which hiked rate by 25 bp. The Swiss National Bank surprised the market with a 50 bp increase, the first in 15 years. But the Bank of Japan kept its policy rate unchanged and maintained the yield curve control, resisting pressures to tighten. The dollar-yen FX spot, already the weakest currency among G10 and Asian currency this year, increased further to 135, which is the highest since 1998 during the Asian financial crisis. On energy prices, oil prices fell the most in 3 months. West Texas Intermediate was down by about 7% last week to $110 per barrel on concerns that economics downturn may reduce fuel consumption. Other commodity prices also fell last week, like aluminium, copper, nickel, and iron ore, down by between 5 and 9% last week. And the US housing markets was showing signs of weakening. The 30-year mortgage fixed rate jumped to almost 6%, which is the highest since 2008. And almost double from 3% in just third quarter last year. The US housing starts declined 14% last month, and building permits dropped by more than forecast. On US-China relationship, it was reported that President Joe Biden may be talking to President Xi Jinping soon, with focus on US tariffs imposed on Chinese goods by the Trump administration. Looking ahead this week, key economic data to watch out for include central bank meetings for Philippines and Indonesia. We have CPI data for Malaysia, Singapore, the UK, and Japan. This morning, we have Suhaimi to comment on US FOMC meeting outcome and Malaysia external trade. Harbin on a special report, ASEAN X Macro, about food inflation. Joey on Indonesia exports, Brian on Laos default risk, Su Tye on Singapore REIT, Sevi on Philippines property, and Chee Ting on regional plantation. And let's start with Suhaimi. Suhaimi, the US FOMC meeting last week, rate hike 75 bp. Was it necessary? What are the key takeaways in your view from the meeting and your expectation going forward?
Hi, morning Winson, morning everyone. So Fed has been raising interest rates by progressively larger quantum in the past 3 meetings, 75 basis point last week after 50 bips last month and 25 bips in March. I think they're forced to do so because they are behind the curve vis-a-vis inflation over there that is stubbornly high at well over 8%. Several key takeaways from last week FOMC. First, for next FOMC meetings on 26, 27 July, Fed Chairman Powell indicates 50 bips to 75 bips hike. Secondly, the latest Fed's dot plot signal another 175 basis point hikes in interest rate for the remaining 4 FOMC meetings this year, thus pushing the Fed fund rate target range to 3.25% to 3.5% by end 2022 from current 1.5% to 1.75%. And the latest dot plots also indicate Fed fund rate peaking at 3.75% in 2023 before dropping to 3.375% in 2024. Fed also made some adjustment in its macro forecast. It raised its 2022 inflation rate forecast to 5.2% from 4.3% back in March, but trimmed by about 0.1 percentage point the inflation rate forecast for 2023 and 2024 to 2.6% and 2.2% respectively. Fed bump up its unemployment rate forecast this year to 3.75%, to 3.9% next year and 4.1% in 2024 respectively, from the rather tight range of 3.5-3.6% 2022 to 2024 previously. And for GDP, growth forecasts are trimmed to sub 2%, 1.7% in this year, next year, and 1.9% in 2024. So that's down from 2.8% in this year, 2.2% next year, and 2% in 2024 previously.
Any impact on ASEAN central banks? Do you think more pressure to hike rate faster?
With Fed front-loading its interest rate hikes and sending Fed fund rate to higher peak level than the last cycle of 2.5%. So we see hawkish pivots among ASEAN central banks. Central banks of Philippines, I think, signaled interest rate hikes this month and August following the 25 basis point increase to 2.25% last month. So they are penciling in a total of 75 basis point increase at this point of time, consistent with our forecast currently for this year. But we do acknowledge there is upside risk of front-loading given the signal by BSP on its near-term policy rate trajectory. And our Thailand economist Joy also revised forecast on Bank of Thailand's benchmark interest rates, now expecting 50 bips hike to 2.1% by end of 2022 and another 50 bips increase next year to 1.5% compared with previous forecast of 25 bips hike this year and 50 bips hikes next year. And for Bank Negara, Malaysia, following the 25 bips hike in May, MPC, we now expect 25 bips hike in the next MPC in July, with the prospect of another 25 bips by end of this year to raise OPR to 2.5% versus our previous view of just another 25 bips hike later this year to 2.25%. But we do maintain our forecast of OPR reaching 3% next year.
Suhaimi, also Malaysia released the trade data last week. It looks like the exports in May was still strong. Which sectors were driving the growth and what is our outlook for the second half?
The export growth in May picked up to 30.5% year-on-year compared with April 21% year-on-year. In April, May 2022, export rose 25.4% year-on-year, even firmer than first quarter growth of 22%. I think this 10th consecutive month of double-digit export growth reflect continued double-digit growth in manufacturing exports, which increased by 27% in May compared with April's 17%. This is amid continued robust E&E exports, which jumped to 45% year-on-year in May compared with April's growth of 27.5%. There's also the surge in agriculture exports, up 44% in May after the growth of 30% in April, and mining export is still running at a robust pace of 55% in May after the 64.5% growth in April. So Malaysia's export are benefiting from surge in commodity prices and robust tech exports, such that, of the growth of 23.5% exports in the first 5 months of this year. Palm oil, LNG, and crude oil contributed to 23% of that, and E&E accounted for another 48%. As for the outlook, rest of the year, we are mindful of the impact to global economic and trade growth from the inflation risk due to commodity price surge following the Russia-Ukraine war. That comes with downsides to Europe economic outlook. There's also the supply chain disruptions from China's lockdown, as well as US-led global interest rate hikes. Even if year-to-date numbers suggest no major damage to Malaysia's exports to Europe, China, and US, but we do expect some moderation in export growth in second half of this year, likely, I think, around low to mid-teens from where we are now.
Thanks, Suhaimi. We'll move to Harbin. Harbin, you have a big report on food inflation, which is a hot topic currently with rising protectionist measures as governments seek to ensure the availability and affordability of food. What are your findings and what is the impact on ASEAN countries?
Hey, hi, morning, Winson. So I think, as you all know, good food prices have risen quite a bit, up 25% just in the first 5 months of this year. And that extends the 28% increase last year. I guess we'll make 4 points on the concerns about food prices. One is actually when you look at ASEAN in the scheme of things, food inflation is actually not too high. It's about 4.2% in April, because when you compare to Europe, food inflation is about 9%, US is close to 10%. And of course, when you look at emerging economies closer to Ukraine, Turkey, 91%, Sri Lanka, 45%, Russia, 21%. You get the point. The ones that are closer and also are affected more by what's happening. So in the scheme of things, when you look at the spectrum of food inflation, Thailand is the highest now, 6.2, but Vietnam is just 1.3. I think there's a point that some of the big food exporters are in ASEAN. There are also some price controls. There are also some fuel subsidies, which has helped to keep the food inflation in check. I think second, the interesting highlight is actually the very high correlation between energy prices and food prices. Because if you think that, for example, climate was a big driver of food prices, you might expect a poor correlation between the two. Climate drives more food. Doesn't seem to be as big a factor for energy. But the correlation is actually about 0.88. That's extremely high. So it's suggesting to us that rising oil prices has been a more powerful driver of food inflation than extreme weather conditions. Of course, this could change as climate change intensifies. But just show that oil is a very important input, whether it's planting, harvesting, or transport. Things like cereals, very energy intensive. And of course, there's an argument about biofuels, right? Whether it's sugar in India or palm oil in Malaysia and Thailand, be used as a substitute, when oil prices rise. But that high correlation means that as oil prices come down, food prices should also come down. And there are signs that oil prices seems to be stabilizing. The third point is to compare this food crisis to the one in 28 and 09. And that episode, if you recall, was driven by rice. Rice took center stage. Vietnam and India imposed export restrictions, and rice prices actually quadrupled, during that time. A bit crazy, but it was really concentrated about rice. But this time around, we think that an export rice ban from India, Vietnam, or Thailand is actually quite unlikely. They're some of the biggest exporters. And that's thanks to ample rice reserves as well as good monsoon season. So that should cushion the the food price impact. This time, the protectionist measures is on other stuff, as you know. It's on palm oil, Indonesia, wheat, from India, sugar from India, chicken, Malaysia. And export restrictions have cut off about 17% of the global food trade. So that's about the same magnitude as the 2007 food crisis. That was the trigger for the Arab Spring uprising, which also toppled some governments. So something to watch, in sort of risks in some of the other countries where food inflation has gone through the roof. But the other restriction is actually on fertilizers. And fertilizer export restrictions by China, and that started in September last year in Russia, have actually cut off about 20% of global fertilizer trade. So that's something, if it relaxes, that could bring down food prices. The fourth point is actually, ASEAN countries are actually big food exporters in general, right? So net food exporters are very large for Myanmar, close to 6% of GDP, Thailand 4%, Malaysia 2.5%, Indonesia 2.3%. So in the scheme of things, you can capitalize on a food price boom. It should actually be good for exports, good for growth. It's negative for the Philippines. Of course, there are some impediments. The shortage of migrant workers is, however, constraining Thailand and Malaysia from fully capitalizing on the food price boom.
Habib, you mentioned in the report there are signs the global food crisis may be nearing its peak. Can you explain why?
So we were worried that this could get worse, but looking at some of the metrics, there's a chance that that the food price, the global food crisis may be near its peak. We think that prices will stay elevated, but the food inflation, that's the rate of change in prices, could come down. It looks as if fertilizer prices have started to fall. It started falling in May, so high prices may have led to demand destruction. There are reports of glut of fertilizers in Brazilian ports. The other good news is actually Russia. Yes, Russia is extending the quotas on some of the nitrogen and complex fertilizers from 1st of July this year to the rest of the year. But the quota now is around 40% higher for nitrogen fertilizers, 11% higher for complex fertilizers. So I think they also need the export revenue. And they're actually going to lift the export ban on ammonium nitrate fertilizers. China is the other one to watch because China's had fertilizer export restrictions since September last year, and that's scheduled to end in June. But we can't decide whether the ban may be extended because the domestic prices of fertilizers is still fairly high in China. Good news that Indonesia has lifted the ban on palm oil exports. It fired the trade minister, I think, for that flip-flop. And Malaysia's chicken ban, we think, will likely be short-lived. And of course, the good news that rice prices are stable. Ample supply will help to contain the food pressure. Reopening of borders will allow foreign workers to return to farms and plantations, easing some of the labor shortages. And of course, we cannot forget the high correlation between global growth and commodity prices. So global growth will stabilize energy prices, maybe bring it down, and that should also cool food commodity prices.
On a separate topic, with aggressive Fed rate hike, what do you think is the implication on Singapore interest rate?
So as Suhaimi has highlighted, and the latest dot plot suggests, the Fed's going to hike by another 175 basis points this year to 3.5%, 3.7% possibly next year. So we had to raise our 3-month SIBOR forecast quite sharply now to 3% for the end of this year, and to 3.2% 2023. The 3-month SORA forecast, which is the new benchmark that's going to be effective from next year, is just slightly lower than that. But it means that corporates and households in Singapore will have to brace for a very big interest rate. How big? Well, mortgage rates could climb to about 4% by end of this year and near 4.5% by end of next year. That's something we haven't seen in about 20 years. So that's going to put a squeeze on consumer budgets, squeeze on cash flow for companies. And I won't be surprised if it cools this property market by next year.
Thanks, Habib. We'll move to Joye. Joye, last week, Indonesia's exports data, the growth and trade surplus, how was it? On a year-to-date basis, it has been unusually strong for Indonesia on exports and trade surplus since the beginning of the pandemic. Was it still the case? Is the latest report show the same trend?
Morning, Winson and everyone. So exports growth in May, the pace softened, rising by 27% from a year ago compared to the 48% pace in April. And that was mainly due to the 3-week ban on palm oil shipments starting the end of April to 23rd of May. And the export slowdown did result in the trade surplus narrowing to just $2.9 billion compared to the $7.6 billion in April. And that was the lowest trade surplus since January 2022. Palm oil exports plunged from a year ago to just $840 million. That's less than 1/3 of the $3 billion recorded in the prior 2 months. And the government has since reversed its export policy yet again, and now is looking to accelerate palm oil shipments. But besides palm oil, other commodities that continued to drive exports growth in May were coal, which nearly doubled from last year. Nickel and articles climbed to a record high, and other contributors to growth were other commodities like copper, as well as ore, slag, and ash.
The Bank Indonesia is having a policy meeting this Thursday. Are they going to hike rate?
Yeah, we expect BI to raise its policy rate by 25 bips in the upcoming meeting this Thursday. Domestic demand in Indonesia has risen to well above pre-pandemic levels. We saw the latest retail sales numbers rising to the highest in 3 years in May, boosted by the Ramadan and Idul Fitri holidays, as well as healthy consumer confidence. Headline inflation has picked up to 3.6% in May, and real interest rate has turned negative for the first time since 2015. The interest rate differential against the Fed funds rate has also widened after the Fed's aggressive hike in the past 3 meetings. So we are still maintaining our view for BI to hike 75 bips in total for this year.
Thanks, Joye. We'll move to Brian. Some updates on Laos. Brian, you have a report on rising debt default risk for the country. Laos economic fundamentals and fiscal position really in a very bad positions? Do you think they are going to default?
Hi, Winson. So yes, they are in a really bad shape. Inflation has surged since the start of the year to 12.8% in May, as compared to 6.3% in January. This is an 18-year high and also the highest in ASEAN, driven by surging fuel prices due to the Russia-Ukraine war and sharp Lao kip depreciation, which has pushed up costs of imports necessary to meet most of its consumer needs. Soaring oil prices have forced importers to cut back on fuel purchases. Consequently, there has been widespread fuel shortages that have disrupted economic activity in many industries. The Lao kip has been ASEAN's worst performing currency, plunging around 25% against the US dollar since the start of this year. This has been due to increasing US interest rates as well as tightening external liquidity constraints for Laos, namely high foreign currency demand to pay for imports and debt servicing requirements against scarce foreign currency reserves. The government is heavily indebted compared to regional peers, with public debt at 88% of GDP, which is a whopping 20 percentage point increase from 2019. Most of the debt is denominated in US dollars and Thai baht, owed to China and Thailand. Foreign reserves are weak at around 1.3 billion USD as of end 2021, enough to cover only around 3 months of imports. Foreign reserves are also insufficient to cover debt service repayments of 1.1 billion USD and 1.4 billion USD due in 2022 and 2023. Further depreciation of the Lao kip will exacerbate debt servicing costs. However, Laos' fiscal deficit is modest at an estimated 1.4% of GDP last year, reflecting the government's considerable efforts to restrain spending and tamp down deficits. Low fiscal deficits will help put a lid on overall borrowing requirements going forward. Growth prospects are also still mildly favorable. The full border reopening in early May will support some recovery in tourism, while the recently completed Laos-China high-speed railway will facilitate FDI inflows. So it's also worth noting that we do not actually regard debt default as being imminent, because there are, in spite of the high indebtedness and rising default risks, there are limited upcoming maturities on commercial debt.
Okay, do they really not have any other financing options?
Yeah, so external financing options are limited given Laos' speculative sovereign credit rating. So for instance, Fitch's rating is CCC, which is well below investment grade, reflecting substantial credit risk. Moody's recently on 14 June 2022 downgraded Laos to CAA3 for its sovereign credit rating, which reflects very high credit risk. But recent history suggests that Laos actually still retains some degree of overseas debt market access. The government managed to issue 5 billion Thai baht, or that's 150 million US dollars bond on 31st March to Thai high net worth investors after nearly 3 years of being shut out. The bond consists of 1.1 billion Thai baht 3-year tranche at 5.8% coupon and 3.88 billion Thai baht 4-year tranche at 6.4% coupon. So these bond proceeds will help Laos to refinance its Thai baht borrowings, which actually make up the bulk of maturing debt this year, and thus help mitigate default risks. Laos debt sustainability going forward is beholden also to bilateral negotiations with major creditors like China, which basically owns, I guess, half of Laos external debt is owed to China. The risk of debt default could be alleviated if China is willing to provide leeway on Laos debt. China has provided debt release in the past. In 2020, Laos had asked China for a debt suspension agreement, and the PBOC also swapped yuan with yuan with the Bank of Laos to help boost foreign reserves.
Okay, thanks, Brian. We'll move to Su Tye to comment on Singapore REIT. Su Tye, in a fast rising interest rate environment, are Singapore REITs going to be the winners or losers, and why?
Thanks, Winson, and morning, everyone. So we expect, funding costs concerns have gained importance for the Singapore REITs with the Fed's steepening rate hike path. I think the REITs had, in anticipation of the higher rates, pushed up their fixed rate borrowings. That's to about 73% on average at the end of March, while the gearing for the sector has stayed low. That's at about 37%, significantly below the 50% limit. And also, if we look at interest cover, that's, I think, manageable for 5 times for the sector on average. So balance sheets-wise, they're strong. But borrowing costs across the sector will likely have bottomed out in the first quarter, now set to rise. So instead of what we initially estimated to go up by about 50 basis points, is now likely to rise by at least 100 basis points, and this is for their floating rate debt. We have already applied this to all our models. When we did this exercise a few weeks back, it resulted in about 1 to 9% cut in terms of our FY22, FY23 DPUs, and a corresponding 2 to 8% reduction in terms of our target prices. The outlook for rates, as we all know, is going to be volatile. And when we took another look at sensitivities for the sector, we expect then another 50 basis points increase in terms of funding costs could lower our DPUs further by an average of about 1.6%. This is less for the industrial REITs, so we think their DPUs are better cushioned than for offices and hospitality, mainly because they have, in general, lower gearing, also, in general, higher fixed rate borrowings. Now, aside from the cost emphasis, then sector fundamentals are improving into the second half. This is driven by stronger leasing momentum, translating into tightening vacancies and then higher rents, which will be accelerating for offices at 12% through next year, followed by retail at 6%, then industrial, which we expect to go up by about 2 to 5%. Now, we are also more optimistic on hospitality. We're projecting 13% to 17% RevPAR growth. Now, this is without the upside from a China reopening. Capital flows-wise, continuing to favor Grade A office and logistics properties, and we will see capital recycling picking up pace as the REITs push ahead on the divestment programs they have to support acquisition growth opportunities if they arise, and then also DPU upside.
Okay, thanks, Su Tye. We'll move to Savvy to comment on Philippines property. Savvy, you did a study on historical shareholders' return of the sector. Can you share what are the findings?
Good morning. I think if we look at the historical shareholder returns, we see that growth, whether you split it into price to earnings and earnings per share, or into price to book and book value per share, we see that growth is a bigger driver than multiple expansion. The 20-year annualized total return of the sector was about 17%. 11 to 12% of that can be attributed to growth in EPS and book value per share. Multiple expansion only contributed 3 to 4%, and dividend yield only 2%. Splitting it on a per company basis, we see a similar trend. SM Prime, Ayala Land, Robinsons Land, Mega World delivered annualized total returns of 11 to 18%. EPS growth contributed 6 to 13% of that, and book value per share growth 8 to 9%. So I think it's really reflective of how generally the Philippine equities have derated over time. the property sector. Multiple factors. You have the pandemic, concerns on the offshore gaming operating sector for property, and then risks relating to the rising interest rate environment. But in general, we've seen the Philippines derate. The property sector is dragged along that. But what I think is encouraging to see is how growth is kind of offsetting the derating of the multiple, or the negative contribution of the multiple to total returns.
Okay, thanks, Sevi. We'll move to Chee Ting on regional plantation. Chee Ting, on Indonesia lifting of exports ban, can you share what is the current situation, and second, how has this policy affected Malaysia, let's say in terms of inventory, exports and prices?
Yeah, good morning. So the immediate 3 weeks after Indonesia lifted the palm oil export on the 23rd of May, exports had not returned to normal due to the reimposition of DMO, or domestic market obligation for short, which is a form of our export quota. So domestically, tanks were filling up fast. Indonesia's stockpile was said to be above 7 million tonnes, or about 2 months of supply. So cognizant of this problem, the Indonesian government introduced a two-pronged strategy. Firstly, it temporarily revised down the export taxes of CPO, RBD palm oil, RBD palm oil, the three main products, to accelerate exports till 31st of July. For instance, export taxes were cut to around $488 per tonne from previously $575 per tonne. However, do bear in mind, the exporters are still required to meet the DMO, whereby for every 5 tonnes of palm oil exported, exporters are required to allocate 1 tonne of palm oil to meet the domestic cooking oil requirements at a discounted price. On the second strategy, for exporters that do not wish or cannot meet the DMO requirements, they can opt to pay an additional special tax of around $200 per tonne. This so-called flush out program runs till 31st July, and the government had approved 1.16 million tonne of such special permits. With the two strategies running concurrently at full steam in the coming weeks, Indonesia is expected to export more than 3 million tonnes of palm oil to ease the stockpile pressure. Unfortunately, the build-up in palm oil stockpile in Malaysia had pressured domestic CPO prices. Based on the latest publicly available data, Indonesia's CPO price has fallen to around 10,834 rupiah per kg as of 16 June, which is the equivalent of around 3,200 ringgit per tonne, its lowest point for 2022, which is about 20% lower than the start of the year. Now, how it impacts Malaysia? Now, the export ban obviously benefited Malaysia. Malaysia's exports for the month of May pick up by 7% month-on-month, and the exports for the month of May pick up 27% month-on-month to 1.36 million tonne, and that actually helped to reduce the stockpile in Malaysia. But following the lifting of the export ban at the end of May, we expect Malaysia's exports to ease in the month of June, which in turn is likely to result in a pickup in terms of MPOB's inventory. Indonesia is the world's largest producer and exporter of palm oil. With the ban lifted and exports slowly normalizing, Indonesia will regain market share at the expense of Malaysia. And as we highlighted in the past, given the higher availability of palm oil to the rest of the world, CPO price is expected to come under pressure, and the industry is just about to enter the seasonal peak production cycle in second half. So since the lifting of the Indonesia's export ban, prices of CPO has dropped from 7,000 ringgit to just below 5,700 ringgit per tonne last Friday, a 19% drop on the Bursa Malaysia derivatives for the immediate month. Barring any weather anomalies, the production of global oilseeds in second half is expected to be good as well, with spring planting progress in the US going as planned thus far. Hence, we expect prices to be weaker in the second half compared to first half on improving supplies. We maintain our 5,000 ringgit per tonne CPO forecast for 2022.
And thanks, Chee Ting, and thanks everyone for joining the call. Have a good week.
To get more information, speak to a Maybank trading rep and check out market insights on the Maybank Trade app. For more weekly updates, also follow us on Spotify and Apple Podcasts. I'm Noelle Lim on ASEAN Speaks by Maybank.